This is 93 Million with Doug Andrew. Welcome to 93 Million with Doug Andrew, where we talk about how to optimize your assets, minimize taxes, and empower the three dimensions of your authentic wealth. My name is Greg Dukowitz, your host, facilitator, and IUL specialist. And in today's show, we're talking about what to expect with the new inflation news. Buy term and invest the difference, and how has life expectancy changed over this century, and how will it affect your retirement? And we're joined by the OG of properly structured IUL, New York Times bestselling author, the author of The Laser Fund, Doug Andrew.
As always, a delight to be here.
Good to have you. Co-author of The Laser Fund, IUL Mastermind, and a man who's better looking than his brother, Emran Andrew.
Absolutely.
Co-author of The Laser Fund, the IUL Einstein, and a man who's also better looking than his brother, Aaron Andrew.
Wait, there's only two of us.
I don't know why I get myself involved in these things. Okay. And our featured host for today, president of Laser Financial and one of the nicest guys you'll ever meet, Brandon Johnson.
Aloha.
Good to have you, Brandon. All right, gentlemen, some exciting topics I'm excited to get to, so let's just jump right in. The latest inflation news is in, but what does it mean? So according to CBS News, the Consumer Price Index in July rose 2.7% on an annual basis, better than the expected 2.8%. Some are saying this is a fantastic sign for the economy, while others are saying tariffs just haven't kicked in yet and the worst is yet to come. Regardless of that answer, one thing is for sure. If you do a small amount of research, you can see that prices are up significantly from since 2019 before the pandemic, right? So
just a little bit. Is it since before the pandemic or since before
the last presidency?
Okay.
So we're going to leave it right there. And some of those laws are passed. Okay. So going back to that CBS News article, since 2019, eggs have gone up 250% in price. Okay, although they are down since a year ago, so that's good. Ground beef is up 54% since 2019, and soft drinks are up 66%. Now that's where I draw the line. Soft drinks.
I'm into the ground beef.
That is too far. Yeah, Aaron's
54.
ground beef. We all have our different turning points. All right, Doug, what do these new numbers mean for our country, and how can people preparing for retirement strategize for inflation?
Great question. At least inflation is slowing down. Okay, it hasn't reversed, and I don't know if it will, but we're on the right track, getting inflation down to under 3%. Okay, I don't know if we'll retroactively get back to where it was in 2019 and all of that. But what does it mean? When people retire, it's about purchasing power. And so you can't be rowing upstream, so to speak, in an investment with money in a bank or credit union, which is pathetic, okay? You can't be rowing upstream at the rate of 3 miles an hour, 3% interest, when the current of inflation's coming down at 6, 7, 8, or 9, which is where we're at.
Right.
Now, if inflation's at 2.6, if you're earning a little bit more than that in a bank, you think, oh, I'm in good shape. No, not really, because if you're earning 2 or 3 or 4 in a bank, that's taxable. After tax, you're probably only keeping even with inflation. So I've always believed you have to have a strategy, an investment vehicle during your golden years where you can outpace inflation and you actually link your returns to the things that inflate. And people say, well, how do you do that? Well, in a nutshell, let's keep it simple. You want to have your money in a position that when certain things go up in price, that you're sort of coming along for the ride, and that you're getting a rate of return that is equal to or greater than the inflation rate. And historically, because of our favorite vehicle, max-funded IUL, you can usually hedge against inflation by 3, 4, 5 percentage points. Higher than the inflation rate. And during high inflationary times, during COVID-19, March 2020, okay? Because of COVID-19, inflation actually was over 9%. You actually triple that. And many of our clients, because we were able to rebalance and use strategies, were able to get credited 15, 25, even 61.33. And so that's what the critical thing is. If you want to stay ahead of inflation, otherwise, inflation combined with taxes you will outlive your money if you live as long as most people are going to be living today. And I think we're going to talk about that even on this podcast.
Yeah, in another segment. Yeah. Emron, thoughts?
The inflation rate is one of the biggest methods the government uses to actually increase our tax bill. I mean, most people don't look at this, but as a taxpayers, your tax bill goes up due to the fact that if inflation goes up, the dollar is worth less. I have to get paid more, right? So my income goes up.
You have to pull out more.
But they do not index tax bracket increases at the same level of even the CPI. I mean, even the CPI underestimates real inflation.
Right.
I mean, it underestimates it. And so even you got real inflation going in, you got your real income, and this is the easiest way that they go ahead. And I mean, all of a sudden, you got to start making, instead of $100,000 a year to pay your bills, you got to make $120,000 to make your bills.
Right.
But all of a sudden, wait a minute, am I going to jump into a new tax bracket?
Right.
It's the easiest way to move people into higher tax brackets, but your standard of living is not going up. It's just significantly going down. This is the easiest way to eliminate the middle class is through inflation. Inflation is the secret to eliminating the middle class.
Yeah, it's like the silent thief. Nobody really directly sees, but it affects a big amount. Aaron, what are your thoughts?
I want to focus on in this topic is just real quick what Doug mentioned is tax-free. You don't realize how much tax-free can help fight against inflation because you have an option of choosing a financial vehicle that's going to be taxes earned or taxable versus tax-free. Of course, because even if you just want to say, okay, what if we earn the same return? Well, something that's taxable and volatile in the market versus something that's got protecting, which IUL or Indexed Universal Life has the protections against market loss, but has the tax-free component, which can really help offset the fight of inflation if things are tax-free. We don't have to worry about the taxes.
Protect the 93 million, right? You got to protect that miracle of compound interest.
Compound interest, tax-free.
Yeah. Brandon, thoughts?
I'll be real quick. I don't care what administration you're in. The answer is not always to print more money. So
that will lead to inflation.
So much money and just circulating too much money. Sometimes less is better. So that's the best thing for inflation moving forward. If we're in a pinch or a crisis, the answer is not print more money and give people stimulus.
Let me ask you guys a quick follow-up before we move on for this. With retirees out there, when they hit retirement, do you think they should just take as much income as they can, like on a flat basis, or should they start out at retirement taking a smaller amount of income and then kind of ramp that up to account for inflation as their retirement years go on? What are your thoughts?
Good question.
It's always a fascinating analysis, right? I mean, this is one of the most fascinating questions we analyze with clients.
I had a client today. They were just saying, "Hey, when I'm 90, I take care of my dad that's 96. He doesn't spend any money. He doesn't spend anything."
Right.
So, okay, it makes the fight like people like, okay, you're going to spend the most in your first 10 years of retirement, then you're going to slow down. So there's that fight. There's also the issue of what about long-term care needs? Of all of a sudden, you're really expensive to take care of and you need more money then. So it's kind of it's a tough call.
But you want to have a plan in place for long-term care, so you're not just blowing through your retirement savings. So
let's spend everything the next 10 years, and you go to long-term care.
Meet with the specialist that can have a plan in place for that. But what you said is right, and it's the first 10 years of retirement is called the go-go.
Yeah, I haven't heard this before.
And then the following 10 years are going to be slow-go years. You're going to slow down. You're not going to maybe have as much energy to go out, travel, spend money, golf, fish, whatever it is, hobbies. You're going to slow down. You're still going to do that stuff. And then you go into the no-go years, like he's talking about, his dad, your client's dad. I mean, you're kind of shut in.
Not my dad, my client's dad.
Your client's dad.
He's not 96.
No. Doug's in the go-go. He's still in the go-go right now.
He'll be go-go forever.
That's right. Yeah. Oh, that's great. Well, coming up, how does living longer, speaking of go-go to no-go, how does living longer affect your retirement? But first, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe and ask us a question or comment. We may use it in one of our next shows. Buy term and invest the difference. That's a common financial phrase that's been around for decades.
I heard that this morning.
Yeah, did you? It is. It has. So if you haven't heard it out there, that's a very common phrase. So what is is it? Well, I asked ChatGPT to condense an explanation down to one sentence. And it said, buy term and invest the difference means choosing inexpensive term life insurance and investing the premium savings so your growing investments eventually replace the need for lifelong coverage. Now, I actually had a client come to me some years ago and say he had fully tested this theory in real life, in real time. He bought a 20-year term policy back some years before he met with me, then invested the savings and what he would have spent on a whole life policy because he actually priced that out. And then 20 years later, it had failed. He had nowhere near what the strategy had promised him, largely due to stock market losses and fees and all the kind of stuff that we talk about, right? That other people don't, right? Mm-hmm. Right? And now, at the time of when I met him, his 20-year policy had expired. So, Emran, can you explain a little bit more on what is this strategy and what are some of the problems with it? Buy term and invest the difference.
You bet. Because all the people that preach it are always so short-sighted.
Right.
They love to take just the premium that you're going to pay on that term policy and add it up over 25 or 30 years and be like, see, that's what you would have paid versus if you go over here, the cost of insurance might be a little bit larger.
Right.
But they don't take into account the lost opportunity cost on that money.
Right.
I mean, if you remember last week episode, we talked about, we kind of talked about this, right? We talked about the fees and stuff like that. So let's just kind of break this down. Let's go to the wisdom board here.
Yeah. So just to break it down. Just to reiterate, he's talking about, so last week we talked about IUL with fees versus other kind of accounts with fees, and you did a breakdown. So check out last week's show if you want. But
we're going to do a review there.
We'll do a quick callback here.
Yep. So what we're looking at is I ran a quick quote, a standard non-tobacco. I mean, obviously, a lot of times when you look at term insurance, you also run into a problem because you also got to get qualified at probably standard to preferred. If you get below standard, it almost becomes cost prohibitive to do a term policy.
Yeah, it's too expensive.
Mm-hmm. Okay, so I did it. Last week we talked about a 45-year-old. So I ran a 45-year-old quote, standard. Okay, standard at a 25-year term to age 70, retired age 70, and $1 million of life insurance. Well, the cost on that policy, I'll just circle it right here. The cost on that policy is $2,772 per year. Mm-hmm. Okay, now that means you lose the opportunity to invest $2,772 every single year. So if you do that from age 45 to age 70, okay, so from age 45 to age 70, that's what you do. 25 years, you're going to lose out on about $175,000.
That money was spent and gone.
You're right.
In other words, that's opportunity cost. It's what you could have made if you had some kind of medium rate of return.
Well, not what he could have made.
6.5%. Yep. Yeah, if you would have invested, that money at 6.5% per year, you would have you lost $175,000.
Right.
Now we did not take this term cost into our cost last week when we did our fees.
Sure. Right.
So if you remember last week, let me just go back here. Sorry, we're going to go back to last week's stuff right here when we looked at $24,000 a year going into a tax-deferred account.
Yeah.
Okay, I've got the IUL on the other side. I'll show you that one right here in a second. I kept the same title. It was my bad, but it is $24,000 going to a tax-deferred account. Okay. And remember from last week's episode here, when we put $24,000 a year into a tax-deferred account, by the time we hit from age 70 and then going all the way to age 100. Okay, so right here we're looking at what is my balance? What are all the fees I paid in all the way to age 100?
Right.
Okay, so if we did that by age 100, you'd have a $6.2 million account.
Sounds pretty good.
But you paid $1.6 million in fees to get there.
That doesn't sound
the
good.
Bottom one?
Yep.
The bottom
but now you don't
fees.
really have $6.2 million because, again, this is tax deferred. I haven't paid in my taxes yet.
Right.
So assuming taxes don't go up, and obviously if you've got $6.2 million, you're probably going to be in a higher tax bracket. I didn't take that into consideration.
So taxes
I just used
not
a
going
nice
up in
low
this
tax. I used today's lower tax rate of 22 or 28%.
Very generous of you.
Okay. Just $1.7 million in taxes.
Oof.
Okay, $1.7 million. That means you only had $4.5 million.
You didn't mention what was the management fee you used, just so people know it wasn't crazy numbers.
About 1 to 1.5%.
I used a 1% between. It was the national average of all fees, both the management fee and the cost of the funds, 1.5%.
Yeah. Right.
That's where we came up with that number.
That's what we did. Okay, so now we've got the $4.5 million. Now we got to take into consideration, again, I actually don't have as much money here because I had to pay that term insurance policy, remember?
That's right.
So
This was from last week, not including any term costs.
I got to deduct the term cost and loss opportunity cost. I got to pull that all out of this $6.2 million.
Right.
So if I pull that all out of this by age 100, that cost you an extra $1,157,000.
That's amazing.
So you wouldn't have actually even net after taxes $4.5 million. You're down to $3.4 million.
Right.
Because that opportunity cost of the 170, it was 170, and then to age 100 got it up to 1.1.
Wow.
Right, Em?
Yeah.
That's the true term cost. The true term cost was $1.1 million.
Right.
Now, if we compare this over here to the IUL strategy, where I'm basically buying term and investing the difference inside of the IUL.
Right.
Under a
Because it's
tax-free umbrella.
right, and it's structured correctly, like you teach, Doug.
Same $24,000 going in from age 45 to age 70, and then letting the account balance grow to age 100. I have $8.7 million. In order to get to $8.7 million, that's net of the fees I had to pay, which were $227,000. So even just the cost of insurance, just $227,000, I'd rather pay $227,000 in these insurance fees than the lost opportunity and the true cost over there of $1.1 million.
Yeah.
I mean, buy term and invest the difference. I mean, wake up, grow up. I mean, it's time.
Like literally grow your money up.
Yes. I mean, it's,
Grow it up tax free.
it's time to stop.
I want to buy a shirt with that little green bar on it and a little red stripe at the bottom. Let's make a shirt.
If that
It's
doesn't
like if you
show
know, you know.
how out of date that advice is. Buy term and invest is such old advice.
I think last time I showed a statement too, like this example I'm showing right now on the screen, it's because IUL is not 1% every year.
Yeah.
You know, the fees, like I have these clients that are 15, 20 years into their policies and their fees are dirt cheap because it's not a percentage of their account balance.
Yeah, it's not like a mammoth.
In that given year, it's less than 1/10 of 1%.
Yeah.
The example we gave was 1/20th of 1%.
Yeah.
Is what the fees were that year in the policy. It's so cheap.
What was
And
the
there's no
death
taxes.
benefit that came along for the ride on that IUL? Emma, do you remember?
When you started it at age 45?
Yeah.
It was right around, it's closer to about 500,000. So I started at around 500,000. That's on an increasing death benefit. I can get the fees to go up from 227 to probably like 245, an extra 20 grand. And you would have started out with a death benefit of over $1 million.
Yeah. But if you're trying to minimize the
which
fees.
would
So if
still
I-
it would have knocked the socks off.
I mean, another $20,000 in fees, and you would have started out with $1 million death benefit instead of a $500,000 death benefit.
And here's the other thing you add to the left side of the ledger. You have one single 2008 year.
Yeah.
And then
boom.
bam, you're in trouble.
Especially
That's a
if it happens while you're
loss.
retired.
Yeah, 40% loss.
Yep.
That's amazing. I'm totally lost. We started with you, Aaron. Aaron, thoughts on this?
No, it's great. So we summarized it very well. Just mentioning, like I said, I got client statements that this is why the costs are so low. Is because it's not a percentage. It's, the cost goes down as you get older in a lot of these. Yeah, I can go up slightly. It depends on the year you look at to be technical. If I want to be real technical.
Sure, of course.
But you look at it, it's like, it's 1/10 of 1% is what the cost is of a lot of these clients that are like 15 years into their policies.
Yeah,
Which is the smartest way to sell.
Which is a big myth that the further on these policies go, they kind of implode because of the fees, and that's not true.
Yeah.
Brandon, anything else you'd add to this discussion?
I love that what Emron showed is basically when you structure it properly, you essentially are buying term and investing the rest. You are investing that money, or you're putting that money to work in a max funded laser fund IUL, which is a properly structured IUL, getting the lowest amount, because he showed like lowest amount of death benefit to minimize fees and costs long term. And so you're doing it within that tax-free bucket.
Yeah. And obviously the death benefit matters. It's super important.
Sure.
But once you establish that need, you can structure it like
The
this.
death benefit is very important because that's what gives you the tax codes.
Exactly.
Tax-free growth, tax-free income, tax-free transfer of wealth.
Yeah. Doug, wrap us up with this entire segment. What are your thoughts?
Well, clear back in the 1970s when I started, I'm pretty old.
Wow.
I was one of the biggest buy term invest the difference proponents in America, okay? Before Universal Life came out.
Yeah, it didn't exist.
I debated on college campuses and so forth. And as I proved mathematically, if you bought term, okay, and did invest the difference, and if you earned a rate of return, and I showed 6%, 9%, 12%, of course, 12% blew whole life out of the water.
Sure, yeah.
But then in 1980, when E.F. Hutton came out with Universal Life, I said, this is by term invested difference on steroids. That's all Universal Life and Index Universal Life is. You're actually self-insuring, as we have explained.
Yeah.
See, and so many of our clients will take out an IUL and they take the least amount of death benefit that they can get away with, and their cash value grows to equal and then exceed the death benefit, sometimes by the 10th, 15th year, age 65, age 70. In other words, your cash has grown to equal and then exceed the death benefit, which is, what the Dave Ramseys say. Well, you buy term and invest the difference, and in 30 years, you won't need the death benefit anymore because your money grew to equal the death benefit.
Right.
Well, why take 30 years to do that when you can do it in 10 or 15 years,
Do it faster, smarter.
It was interesting when I used to debate the John Savages, and he was a whole life guru, but he would use the metaphor, well, do you own a boat? Well, why don't you buy a canoe and invest the difference? Do you have a car? Why don't you just buy a scooter and invest the difference? Emran, you just bought a nice surfing boat. Why don't you just buy a little canoe?
Yeah.
You want to buy a deluxe. Actually, the metaphor can work because some people say, well, why would you buy that expensive IUL?
Right.
Because it is the package that does exactly what we're talking about.
Right.
It helps you buy term and invest the difference.
Yeah, buy term and invest the difference.
The only
on
reason
steroids.
why whole lifers said, well, because it's a forced savings. Americans need a disciplined system. Well, if you want to get IUL, it's not forced, but anyway.
Oh, that's great.
One of my favorite parts about that whole story is that, Doug, my dad was one of the biggest
proponents.
Buy term and invest the difference.
Yeah.
And when something changed,
he was open-minded.
Exactly. People need to quit following outdated advice.
Don't follow the crowd. Where have I heard that before?
And they do. And some of them dig in their heels and they just pound that key, even though mathematically I go, what are you talking about here?
Yeah.
You get stuck in a rut and you won't get out of the rut.
Yeah. We've even played some of their video clips on these podcasts. All right. Coming up, how has life expectancy changed over the century? But first, if you're enjoying this content and you're wondering how to take advantage of these ideas, Laser Financial helps individuals and families like yours implement proven strategies to grow and protect your wealth. One of the most powerful tools is an Index Universal Life Policy, or IUL. It's not just insurance, it's a tax-free retirement strategy, a way to grow your money with compound interest and a safety net against market downturns. Imagine being protected from market losses while still participating when the market goes up and having tax-free income that allows you to keep more of what you've worked so hard to save. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. That's laserfinancial.com or call 801-505-0409. Don't wait. Take the first step toward a brighter, more secure financial future today. Are you a financial professional wondering how you can expand your business working with IUL? Are you leveraging IUL to its full potential? That's where IUL Insiders comes in. In the upcoming weeks, they're hosting the IUL Challenge. It's a free 3-day event designed specifically for financial professionals to help you build a thriving, scalable business that sets you apart from the competition. You'll learn proven strategies to market, design, and sell properly structured policies that deliver incredible results for your clients and for your bottom line. If you're ready to elevate your practice and scale your business, visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. What does a longer life expectancy mean for you? Well, according to the Hamilton Project, since the year 1900, life expectancy has increased by approximately 25 years. That's a pretty big number for life expectancy to increase.
Yeah.
So if you go to the time that Social Security was introduced around the 1930s, the life expectancy for men was age 58 and age 62 for women, and the retirement age was 65.
Man, they were actually ingenious when they came out with this.
I know.
You're dead before
retirement
the
age.
average person is dead before they ever collected.
Right. Now, to that point, even accounting for infant mortality rates, right? Because you don't contribute to Social Security when you're a baby, right?
Yeah.
So accounting for infant mortality rates, which have skewed the results, the life expectancy after reaching adulthood, which is more true, right? After reaching adulthood was age 65, which is the same as the retirement age, right? Now, what about now? That number is age 80. So 65 to 80. And by the way, the retirement age that people kind of generally think of, or the FRA, hasn't really changed much over the years.
Still 65.
People still
maybe pushing to 70.
60 or 67, right? Maybe 70.
Maybe.
But most people generally think, oh yeah,
65.
65. That's the retirement age.
Yeah.
So that's interesting. Aaron, what does a long life expectancy mean to the average person out there preparing for or even in retirement?
You're gonna run out of money.
Wow, it's very positive.
Yeah. No, but really, that's the biggest fear you all have, isn't it?
Right.
Everybody out there, just think in your heads, what's the biggest fear you have as you're preparing for retirement? Everyone is talking about
100%.
I don't want to run out of money.
Right.
How do I protect against that? So that's one of the biggest fears. And so life expectancy is a very important thing. I always ask clients, hey, what do you think your LE is? What do you think your life expectancy is?
Right.
I'm kind of surprised by the answers.
Yeah.
Clients are like, oh, I'm only going to live another 5 or 10 years. I'm like, really?
Yeah.
I mean, a lot of people are going to live a lot longer, like we're saying here. So we need to plan for that and be careful because, and technology, people are living longer and longer.
Yeah, it's interesting. Even people who that we know they have a lot of money and you think, oh, I'm sure they feel secure. They still worry about running out of money.
Oh, absolutely.
I just, I met with someone just barely this morning who's worth $10 million and he's still worried about running out of money.
And that's amazing. Brandon, what are your thoughts on this?
Create predictable income streams.
Seriously,
people get so caught up in
predictability.
Look at what my
Denmark
returns are.
kangaroo orange.
Yeah, that my account, the market's up, but I'm getting this. And they're they're aging into retirement years, and it's like preservation and protection is more important. Prediction of income that's coming in, covering expenses, making sure that you can't outlive. And there are specific financial instruments and strategies that are designed to guarantee that you will not outlive that income. And so those are strategies that you should be looking at if you haven't.
Yeah, that's a really good thought. Emron, thoughts?
Well, you kind of have two choices as you're approaching retirement. I mean, honestly, you're either going to go ahead and you got to think better, think smarter with your money if you're going to have if life expectancy is going bigger. That's why people are worried about it. Or don't retire so soon. Work longer.
Yeah.
Again, if Social Security is not going to, is going to run out. I mean, it was not going to start until the average life expectancy of people.
Right.
I mean, then if we follow that same trend, you shouldn't stop working until you're 80.
Yeah.
Right.
Yeah.
And then if you work till you're 80, then you won't be worried about running out of money.
Right. It makes a big difference.
So, it's one of my dad's favorite cartoons. I think he always shows me. It said, what was it again? It's got this drag couple and they're.
How's it go, Dad?
If we take a late retirement.
A late retirement, okay, and an early death,
we might
squeak by.
Exactly.
So good.
I mean, that doesn't
So
sound like
great.
any kind of good retirement.
Right.
And you can avoid this. You don't have to take a late retirement or an early death.
Yeah.
You just have to start thinking differently now.
Yeah. Yeah.
Make the best choices now. Change it now.
Yeah. And it is funny because some people are on the reverse. They don't have a lot of money and they want to retire at like age 50.
Oh my gosh.
You know what I mean?
It's the most common person
it's
would get it.
amazing.
Yes.
And if that's you out there, just reality needs to set in.
Yeah.
To be honest, sometimes you guys need we need a reality check.
Right.
Yep.
It's like you need to keep working. Find something you love to do.
Yeah.
It's okay if you switch occupations, maybe make a little less if you want to work long. But some of you we just need to keep working.
Yeah,
it's
my
okay.
favorite one is the guy that comes in, got $25,000. I want $1 million in 10 years and retire.
Yeah.
And I'm like, well, you're not in the right place because there's no way I'm
You
turning.
get the heat back with how much wood you put in the fire.
I can't take 25 grand and turn it into $1 million in 10 years without some additional sweat equity. I mean, it's all on its own.
They're trying to make up for all the time they were consuming,
Yeah.
spending money. But here's really the point, I think, with this. The financial services industry standard, says that if you accumulated $1 million in your yet-to-be taxed IRAs and 401ks, they only want you to withdraw 4%. It's called the 4% rule, because that's the average return with money in the market is 3.5%. Okay. People buy and sell at the wrong times. And so that's what precipitated the 4% rule. Well, you pull out 40,000 out of $1 million nest egg, even in a 25% tax bracket, you're only netting 30,000 or 3%. Okay. Now, I like max funded IUL because if they have $1 million, I can be conservative and show them double that. 60,000 a year, a 6% payout, and it's tax free. Now, if they're the go-go years and they want more, they can take out 80,000 a year, 8%. You know, we can even illustrate a 10% payout without depleting principal for many of our clients. But I still appreciate the clients who were mature. Like Aaron has a client that they did the strategic rollouts, bit the bullet, paid the tax, and ended up with $4 million. And then after 7.5 years, it grew to $8 million. And they could withdraw $600,000 to $800,000 a year, but I think they only take out $300,000. It is tax free.
200, sometimes 250.
200,
Wow.
300,000, and yet they could take out 800,000 if they really needed it. Okay,
Right.
Or they could go grab 94% of their $8 million if push came to shove.
Right.
But they don't, and they say, well, we just have a huge hedge against inflation, and if we live a long time, we don't have to worry about it.
Yeah. Again, it's that worry about not outliving their money.
Yeah.
Right.
Yeah.
Let me ask one final question. I'll just throw out to the group. Does life expectancy, being so much further along, has that put a strain on government programs like Social Security?
Absolutely. Yeah. I mean, Medicare, Social Security, absolutely everything.
Yeah.
Puts
That's why
a
it's out of
huge
money.
strain on it. Yeah. I mean, they're going to have to just keep pushing, like, how.
Because for Social Security, the retirement age, the life expectancy went up, but the retirement age didn't. It stayed there.
Yeah, I mean, it's just going to look different. Like people, they're going to move the age to when full retirement age or Social Security age is. When our kids, I don't even know what it will look like for them. I mean, the benefit amount will go down. They'll push the age when you can start.
Well, they should have done it
They got
already.
to push
and they
the age
haven't.
to 80 right now.
Yeah.
Just
Yeah,
to
I mean, they
save
have
Social
to.
Security, you've got to push your Social Security benefits to age 80 right now. That's how bad we're at right now.
So who's going to be a proponent of that tax bill?
Nobody, because no one will get elected.
It's political suicide. It's political
Right.
suicide.
It is.
Right?
It absolutely
It is.
is.
The thing that people don't realize, Social Security came out during the Industrial Revolution.
Right.
And that's when they came up with retirement, okay? You retired worn out equipment. You put it out of use. So let's put people out of use. The life expectancy when Social Security was introduced was 7 years, okay? 6 years for a government retiree. Did you know that? And 5 years for a military that was put out of use.
Wow.
They just felt like, what's life worth living for, okay? So Social Security was never designed to pay out benefits for more than 7 years, and most people were dying sooner than later, okay? Now people are living longer, okay? But when it came out, there were 24 workers to every one recipient. I remember when it went down to 16 to 1, and then 6 to 1, it's 2 to 1.
Yeah.
There are 2 workers out there pulling the wagon for every Social Security recipient riding in the wagon.
Scary.
Yeah.
And something's got to change.
It's not sustainable. I mean, that's why you just go to ssa.gov
Yeah.
and they've got warnings right there. The government's
Right.
been warning us for the last 20 years. This isn't going to last. It's going out. I mean, it's going bankrupt in the next, in less than 10 years, it's gone.
Yeah.
Yeah, I mean, Doug said it's 2 to 1. It's trending soon. It's
Well,
gonna be
the
1 to 1.
upcoming
Right.
Like, what happens then?
Yeah.
workforce is smaller than the baby boomer retiring workforce.
Yeah.
And so it's a train wreck waiting to happen, but politicians don't want to touch it.
So in the meantime, we got to protect ourselves, right? Make sure you take care of yourself and you plan, strategize.
Social Security should be a bonus for your retirement, not the basis of your retirement.
Here, here. All right. Again, if you're wondering how to take advantage of these ideas, visit laserfinancial.com to learn more. Or if you're a financial professional and you'd like to participate in our upcoming 3-day IUL challenge, visit IULchallenge.com/93. Okay. Now time for our podcast question of the day. User Charles Robinson, 6715 asks, what is a good financial company to work with? Brandon, I'm going to throw this question to you. How would you respond to Charles Robinson?
not to dodge this question, but I mean, so you're focusing on the financial company, and I'm going to quote a wise man named Emran Andrew, who probably got it from his dad.
Wait, I have original ideas.
Hold on.
Does it have anything to do with wisdom?
Lots of wisdom.
Okay, then it
Lots of
came
wisdom.
from his dad.
Let me just, it's a simple golf analogy, and you've probably heard us use this before if you've watched this, but if you know who Scotty Scheffler is, he is the best golfer in the world right now, right?
Number one,
He's
number
top
one.
of the game, right?
Yeah.
And if I could tell you, it's Charles, right? Charles that asked the question.
Yes.
Charles,
Yeah,
would you
Charles.
rather have the clubs? You know, if it's Titleist clubs or Cleveland clubs or whatever the popular clubs are, would you rather have the clubs that Scotty Scheffler uses or Scotty Scheffler's swing? So the swing is the strategy. And so what I tell you is find a financial firm, you know, Laser Financial is a great firm that teaches you the right swing, right?
Yeah.
There are really good companies out there that we work with, that we plug our clients into, that are A+ rated. They've been around for 100+ years. And those are things that, you know, you can research and look at. But the swing is so important. And that's what we teach people, is all these things that we've talked about today. Tax-free, like how to protect and preserve against volatility. That's part of the swing, structuring it properly, like what Emran just went through and showed on that. So that's what I would say to Charles is focus on working with a specialist who has the experience, that understands the swing, knows the swing, that can teach you the Scotty Scheffler swing that you can then
I mean, that's so true, so profound, because it's more so. I mean, obviously, we've proven it over and over when you work with us with IUL, but you can apply it to anything financial, real estate.
Yep.
Okay, I mean, you just can't go out and buy. It's all about your strategy in stocks. Is there a magic stock out there? No. What's your strategy around stock? I mean,
Right.
it doesn't matter what it is.
I know day trading is a popular
Club
thing, like
The swing
versus the
versus
stock.
the-
Yeah,
there's a strategy to it, right?
Yes.
There's-
What is your strategy around it? It's that's what you got to lean into.
And it doesn't get this simple, but there was a movie, I can't remember, a golf movie where he only used a 7-iron the entire game to drive,
Wow.
Happy Gilmore?
to chip, to putt,
You got to go way older than that.
and he
Way older.
knew how to angle the 7-iron.
Yeah.
So it was the swing. That show proved that it's the swing more than the clubs.
That's amazing.
And he scored amazing using a 7-iron only the entire.
I got to find that, and you will use it on a segment.
Okay, super.
That'd
But
be-
anyway,
that'd be cool.
we're not going that extreme. But the point is, I'd rather have the swing any day.
You're gonna have to go way.
It's a
back
long
in the
time
archives.
ago in
Yeah.
the archives.
But full circle, the swing is hopefully us. That's what we mean.
Yeah. Yeah.
Is we can help you design the policy correctly, design it correctly, and work with you, because we get people all the time that come that it ended up getting, you know, a policy done elsewhere.
Yeah.
And it wasn't done right. And we've got the swing down.
all the time. And it's
We've got the
great
structure.
companies that they set it up with. It just wasn't.
Oh, just
structured
this morning,
the right
this
way.
guy, he was like complaining about the company. It's like, oh, that's a great company, life insurance company, but the agent designed it incorrectly.
Yeah.
Right.
That's the whole issue.
Well said. All right. Well, that's all the time we have for today. Roll with inflation, outpace it. Don't outlast your money, and we will see you next time on 93 Million. Thanks, everybody.
Thank you.
Take care.
Good luck.